I think many people kind of realize on Friday that perps may not always be the strongest or safest instrument. Sometimes like liquidity is reduced automatically before like market makers can even react and reintroduce liquidity in the market, which I think once again adds into the whole perfect storm dynamic.
What do you think about Hyperliquid? Is Hyperliquid a winner or loser coming out of this? I'm optimistic and bullish now.
Hi everyone, welcome to another episode of Bits and Bips, the show where we explore crypto and macro colliding one basis point at a time. This is a very special episode, just given what's happened in the market over the last, almost 72 hours or so. Typically, we're trying to decide what we're going to talk about, DATs, Trump, Fed policy. None of that is an issue today. We're going to discuss what happened on Friday, lessons learned over the weekend, and more or less how crypto is going to respond moving forward.
Aptos is the no-compromise infrastructure for global financial markets. Fast, reliable, and 100 times more cost-efficient than other blockchains. See for yourself why Aptos is the chain of choice for institutions, users, and developers alike at the Aptos Experience, October 15th and 16th in Brooklyn.
But first, just a few quick introductions. I am your host, Steve Ehrlich, High Scribe of the Unchained Kingdom. I'm here, as always, with Ahluwalia, the Maester of Wealth, leader of Lumida, and we've got two very special guests. So let's introduce them quickly. First, we have Carlos Guzman, Chief Scholar of the GSR Citadel. So welcome, Carlos.
Hello, love the name.
Carlos, why don't you just briefly tell us a little bit about yourself? I would imagine most of our viewers and listeners are familiar with GSR, one of the larger market makers in the space.
Yeah, sure thing. So I'm a research analyst at GSR. We're a big market maker across exchanges, centralized exchanges, and centralized exchanges in crypto. Also big OTC desk and systematic OTC desk. And yeah, we partner with projects to provide liquidity and just also as a broader capital markets partner across advisory, help with treasury management, and a bunch of just other places in the space, including as a big investor as well. So yeah, pleased to be here.
And we also have YQ, commander of the roll-up armies at AltLayer. And a special thank you to YQ for joining us because he's in Singapore, where it is right now 2:30 in the morning for him. So YQ, welcome.
Yeah, thank you, Stephen.
Okay. As always, but especially true today, nothing that we say here is financial or investment advice. Please check out unchainedcrypto.com/bits and bips for more details and disclosures on that. And with that introduction, let's kind of just dive right into it. Everybody was getting ready for the weekend. I had some big plans, and then Trump decided to threaten a 100% tariff on China due to export restrictions on raw earth minerals, and all hell broke loose. Ram, why don't we just start with you? What were some of your first thoughts and reactions?
Right. So on Friday around 10 or 11 a.m. Eastern time, Trump shared a tweet saying that he would raise tariffs on China, something like 100% or so. That caused a sell-off in equities, and which up until that point in time were up something like 1 to 2% on the day. So you had a nice rally. And then so equities started to slide, closed down the day, several points, 3.5 points, depending on which index you're looking at. The volatility fear gauge index jumped 30%. And then digital assets also took a tumble. And within digital assets, you had altcoins that were down 60 to 80% within 24 hours. And what happened there, briefly, I'm sure our guests will unpack it for us, is you had forced liquidations that were done algorithmically, just autonomous code that was running and seeking to protect the network by liquidating positions. You had faulty oracles set up at exchanges that were pointing to the wrong reference spot data, and kind of reminiscent of what happened with 1987 crash portfolio insurance, where you had a mechanism that was nominally designed to protect investors, but actually had a pro-cyclical phenomena. So it's this classic tale of a crypto speedrunning banking and markets history. In 2021, it was rehypothecation with the blowup of Celsius and Genesis and these other lenders. So crypto learned that you shouldn't rehypothecate unless you're a bank with the lender of last resort and FDIC insurance. So here's a next lesson is really on the market side of things. Although it's quickly recovered, it's really unfortunate. I mean, the despondency that was out there. You had people that lost their life savings. They were acting in their minds prudently too. Dollar cost averaging over several years, but they were forced liquidated. They might have had some leverage, and this was all in the perps market primarily, where this pain was meted out. The spot market also, of course, had some volatility, but not nearly as much as what you saw in perps, and especially on Binance. So an incredible couple of days. I think there are winners and losers coming out of all this. I imagine we'll get into who those winners and losers are, but pass the ball.
Yeah. Well, speaking of the winners and losers, I mean, YQ, you had a really interesting article on X. There's a lot of there's a lot of discussion, I guess, in the air supply. Was this a coordinated attack? Did CZ try to take out Hyperliquid? But it looks like certain attackers, if you read the tea leaves the right way, they nuked ENA or USDe on Binance, led to a concentrated crash on certain tokens because of a window of opportunity related to oracles on that particular platform that then they were able to take advantage of on Hyperliquid to the tune of, I think, $192 million and caused something close to $10 billion in liquidations on Hyperliquid. Can you kind of just walk us through that? And in the ensuing time since you posted that, what have you learned that may or may not change any of your opinions or conclusions?
Yeah. So as you mentioned, right, there are a lot of coincidences. Like after I really dig into a lot of details regarding this kind of the biggest crypto liquidation event. Like regarding the timeline, right, as Rat mentioned, but here I will just use the Singapore time zone as the reference. So actually the market started to behave after this kind of announcement on the tariff news around like 5 a.m. In Singapore time on Saturday. And then after that, basically the crypto market started to behave like basically there are a lot of sort of shorts, and basically the entire market plunged a lot until like sort of 5:20. If you look at the chart, right, no matter for the majors like Bitcoin, ETH, or some other altcoins, right, and basically drop like dramatically. Like this sort of 30%, 50%, or even like sort of 99%. I was somehow awake at that time. So basically, I literally watching this kind of a waterfall drop for most of these altcoins. And then it's sort of like the first round of liquidation. Like from the other reports, like some like sort of there also this kind of liquidity vacuum. Basically due to a lot of traders, market makers, they withdraw the liquidity from it. And it's also because like the market reaction was huge, and basically it also triggered no matter the CEX ADL on the auto deleveraging mechanism, all these kind of like DEX, perp DEX, like Hyperliquid is ADL. So then like sort of around is 5:43 a.m. Basically, the USDe and the WBETH and also BNSO started to collapse. Around that time, around like sort of 60 million USD equivalent, like sort of USDe dumped on the market. Of course, there are multiple reasons, right? Like there's some reason like say, okay, it was caused by the first round liquidation, and a lot of positions or collaterals basically not enough to cover the margin. So then like sort of the exchange take over like sort of their margin and start to dump on the spot market. So that caused a depeg of USDe. And after that, because like on Binance or some exchanges, right, they use the WBETH and the BNSO as a collateral for their margin. So in that case, like further cause this kind of loop of liquidation. until like sort of the next half hour or 1 hour, the entire like sort of market structure like basically is completely off. And why we feel like it's not just a single liquidation, because there are two rounds. One is like sort of this odds liquidation around like 520, and there's another further second round of liquidation, including the depegging of USDe around like 543 and 544 a.m. And beyond that, why we like sort of in the posts or like sort of tweets, right? I feel like probably also can be a coordinated attack is because like around a few days ago, back in 6th October, Binance announced like they will start to do some adjustment of this Oracle for the BNSO and also WBETH, and which will be conducted around like 14th of October. It's just like so coincidence, like just between these few days, right? And then like it's not just about the first liquidation of all coins, but the second liquidation like directly target like sort of the three assets, USDe, BNSO, and also the WBETH. It's basically exactly sort of the assets and like in the announcement. So that's why we feel like probably can be a target, a coordinate attack on it. And then in the third like sort of article I mentioned, right, is somehow it's related to this Oracle problem. We're quite familiar with Oracle for the DAX, right? Compound, RV, and also like but the things like for CEX, especially for this specific case, right? For example, USDe, INSO, and also WBETH. Before the adjustment, partial of this price index is associated with the spot price. So that's why in the second liquidation, we can see that when sort of the price was down and basically you unless you have a lot of liquidity to buy it back, otherwise you have the price down, the Oracle, I mean the market price is down further. So it's really caused this kind of cascading liquidation. So that's one of the like reasons we feel like the root cause maybe just about the Oracle.
Well, there were large short positions placed prior to the sell-off, and you can see these on chain, like 100 million, 200 million plus short positions that also covered at the opportune time. So it does look suspicious, but you kind of, in your theory of it, which I think is a good theory, by the way, it's very suspicious. Now the question is like, who would be the actor here? It seems like the core issue was that Binance was using its own spot order book to measure the collateral value, as opposed to a third-party Oracle that's taking the median of the bid-ask spread across multiple venues weighted by liquidity or something like that. So you can get a mismatch between Binance's the spot prices on their order book, which they're using for risk management and margin maintenance, variation margin, and liquidations, against what the prevailing market is, to your point. So if I build on kind of your theory, someone that understood the inner workings of this or just saw the announcement from Binance that they're going to change this, in a way, it's like a 0-day hack, right? A 0-day hack is an exploit that you can take advantage of, but there's no patch for. Now, this isn't a cybersecurity hack. It's a market microstructure hack. There's a gap in the market. So one alternative explanation is that when Binance announced that, whoever had studied this structure, they knew they had a short window in time to take advantage of it. You combine that with Trump's news, it created the perfect window, especially going into the weekend when everyone's asleep and liquidity is extremely low and you can push a market.
Yeah. It sounds
I'm in conspiracy tinfoil camp too on this one.
It sounds almost something more akin to like a flash loan type attack, because like there was no vulnerability that was exploited as you mentioned, Ram. Like they went right through the front door and used publicly available information to take advantage of something. I mean, it gets tricky if I mean, as we're all wearing our tinfoil hats, they're conspiring to drive down the prices of particular tokens and then doubling down by placing massive short positions at what happens to be Binance's chief rival, like the first exchange that's really made Binance sweat in years. But we'll see. I want to get
Binance came out with an apology. Don't forget, just to show they're part of the story. They said, "Hey, we have a lot of lessons learned from this." Yeah. And you might make the case that maybe North Korea was the perpetrator. I'm just like, they're still not clear. But anyway, go ahead.
Yeah, I mean, it's one of those things where, I mean, like Occam's razor, what's the most likely scenario or most likely explanation? Like, and YQ, you even mentioned this in your report. Like, there is a way to read all of these different clues and say it was not some sort of conspiratorial attack, but it was just a couple of opportunistic actors, and just a perfect storm of events. But hey, it's always fun to wildly speculate. So let's do that as well. Carlos, I want to kind of get your point of view in here, and like it's really interesting. You're at GSR. I mean, you kind of pitch yourselves as like the capital markets partners, and I'm sure you do plenty of business at Binance. I mean, from your point of view, like what was going on at that time, and like how does a company like GSR respond to something like this when it certainly appears that a lot of like the more like market neutral players were the ones at most risk during this acute period of time on Friday?
Yeah, no, for sure. I mean, I think Friday was just a perfect storm of all these risks. I think I think right after like Trump tweeted, you get like a big market dump and then just an incredible wave of liquidations in perps. I think we just seen lots and lots of leverage accumulate in perps. And I think just like when markets are falling, I think the natural reaction, I mean, for big institutional players like GSR, it's extremely important for us to take risk management extremely seriously. And I think many players like did that at the top. And we do that across like many venues and across many different instruments. I think many people kind of realized on Friday that perps may not always be the strongest or safest instrument. I think, I mean, part of the story of Friday is learning about counterparty risk and exchange risk. So for instance, I mean, we saw a lot of people get liquidated on the long side, but then on the short side, once ADL kicked in to secure exchanges solvencies, many people's short positions also got closed. Oftentimes, at P&Ls much lower than they would have expected. I think this has the potential to have realized pretty significant losses for funds running long, short strategies, funds running like delta neutral strategies. Market makers like GSR, we run like delta neutral strategies, but we're not only using perps. So, I mean, fortunately for us, we were not majorly affected, but it can be the case that other kind of big funds might have been.
And I think that was a rumor that you had the destruction of one or more of these market makers over the weekend. You would be one of the first to know.
Yeah, I mean, I've only seen rumors so far, nothing really concrete or substantial.
Right.
But I think for market makers that took, I mean, market makers like GSR are very much aware of like all these mechanisms that can happen when we take risk management really serious.
What did GSR do? I know you're on the analyst side rather than you're on the research side rather than the trading side, but there were points on Saturday where the bid-ask spread on assets was 30%. It's insane. Okay, put that in perspective. If you want to get into position, you're paying 30% more or 30% less if you want to get out of position. There's no liquidity. And the other part is that the other kind of learning from all this is that I think a lot of people probably know this, but the fact that it happened all at once in the situation is that there's limited depth of order book the farther away you go from the prevailing market price, right? Think about like how DEXs work, like Uniswap, for example. They use these concepts like bonding curves to create liquidity. Bonding curves is just a fancy word for a math formula that describes a change in price relative to, demand of one unit in this pair relationship. That's it. Nothing fancy about that. And, I guess that system worked. But clearly, if you're seeing a bid-ask spread of 30 points wide, no one was providing liquidity then. The market makers, it seems that market makers had completely withdrawn. And if you were trying to get involved and take advantage of that, you could, but you're paying through the nose just to enter the market.
Yeah. And actually, I want to just build on that, Carlos, before you respond too. I think there's a bigger lesson here to learn, and for people watching, to understand liquidity, especially for alts. I mean, not the Bitcoin and ETH and Solana, but I mean, and I'm not even just talking about what acutely happened on Binance, but it's hard for people watching to understand order book depth, especially when exchanges and tokens employ market makers that do a very legitimate, play a very legitimate role in trying to maintain orderly markets. But something like this happens, and like Warren Buffett says, you kind of see who was swimming with no clothes. Like, how should people trying to understand what happened, and at some point they're going to get back into alts, like what are some of the lessons they can learn to understand and make better decisions on where to trade and avoid some of those that slippage that Ron was alluding to?
Yeah, for sure. So, I mean, getting a bit into Ram's point, Friday was extremely chaotic. I mean, I think we saw a lot of exchanges also kind of start to not operate like fully well. Orders weren't executing, APIs weren't like fully working. I think we also like saw some UI issues. But what also tends to happen in these kinds of situations when there's a big market drop, oftentimes liquidity is reduced as market makers are basically managing risk or quoting wider spreads, because oftentimes it's without information on what exactly is happening. Market makers can't quite confidently quote at a certain price before you fully know, okay, is this some sort of exogenous major event? Is this more like related to like the price of a specific asset? Before like information really comes through, before things are clear, and market makers can once again confidently start quoting prices. Market makers tend to look, in periods of uncertainty, and oftentimes this is just coded into bots and automated algorithms. So sometimes like liquidity is reduced automatically before like market makers can even react and reintroduce liquidity in the market, which I think once again adds into the whole perfect storm dynamic. So you're getting liquidations into markets that are getting much thinner in liquidity, which leads to like further price drops, which then leads to further liquidations into low liquidity markets. So yeah, this is all just a vicious cycle. That basically.
So this happened in the U.S. equities market in 2011. There was a flash crash, for those that remember. And the biggest critique of the U.S. equity markets after the passage of Reg NMS in 2007's Regulation National Market System, which was designed to create competition for the New York Stock Exchange and NASDAQ, which were the then duopoly where transactions happened, that Reg NMS was passed to create competition. So you had the explosion of other exchanges like Arca, building on the success of like Instinet and Island, Archipelago, and dozens of other exchanges. And it also led to the rise of high-frequency trading, okay? So the criticism was that Reg NMS created phantom liquidity. Phantom liquidity. What is phantom liquidity? So it's a fact that execution for U.S. equity investors is better today than it's ever been before in history. You can hit a market order buy, market order sell on many stocks, and you'll get a decent fill versus the slippage or the bid-ask spread, or different metrics to look at, versus it was, say, 30 years ago, where you're paying like an eighth and a 16th, okay? Now you're paying what are called like mils, fractions of a penny. So now we've had a flash crash in the digital asset market, and it reminds me of what we saw in the equity market back in 2011. So I think some people look at this very critically and say, look, crypto is just a bunch of nonsense. Like, well, look, I mean, this did happen in the U.S. equity market too. There was also, there are examples in the U.S. equity market where things like this happened. There are issues that have happened, and then there's a market response. There's an investment infrastructure. Players learn, and then the market heals and moves on.
I want to add a little bit like sort of stuff here because like I've been in crypto over a decade since 2015, and I have a lot of friends running liquid funds, and also some of they are traders either on the CEX or the sort of perpetuals. So right after this kind of crash, I had a bunch of call with them. Some of them got hit. The thing is like as Stephen just mentioned, right? The thing is like previously people feel like perp is super useful, and they do they do hedging, like sort of the long these kind of altcoins and do short the long like sort of Bitcoin and do short on altcoins. For example, long on Bitcoin and short on Dogecoin. But during the crash, due to the ADL, their short position was forced to close. So in that case, there are no more like sort of hedge, and due to whatever reason, glitches of the server, whatever, right? You couldn't put bids on time. So that's sort of like basically during the crash, any hedge no longer working. So what you can do at that time, like basically try to hold all assets in spot. So that's why a lot of my friends after this kind of crash, they told me that don't use perp for hedging anymore. The because like another issue is still back to the Oracle issue. A lot of these CEX, DX, they are using the spot price as a market price. And so as Ram mentioned, right, there's basically no liquidity during the crash, and you can easily manipulate the spot price. Further liquidation from the other collaterals, whatever, it further drop that sort of the mark price for perp. So in that case, like you can't do hedge, and you can only hold that sort of the assets. Beyond that, it's just like based on their feedback, right? Another thing they mention is like so basically the liquidity or the spreads on like sort of CEX or DX is not trustworthy. As Rajan mentioned, right, you can have some phantom or ghost like sort of spreads, and once there was a crash happening, right, it's basically all liquidity withdrawn. And like one thing like probably we can trust is AMM, because most of the LPs on chain, and you can't like sometimes like the chain like sort of got stuck, right? You couldn't really withdraw the asset immediately, so the liquidity just stick there. But in general, I just feel like the main issue is still like we need more this kind of liquidity around this kind of crash. Of course, it's super risky, but like I just feel like it's if we don't have enough liquidity, like basically around this kind of crash, there's so many places can be manipulated. Yeah.
Before we move on, we do need to take a very quick break so we can hear from the sponsors who make the show possible.
Over 3.4 billion transactions processed without disruption. More than $1 billion in stablecoins circulating. Over $720 million in real-world assets tokenized on-chain. All delivered with sub-second finality, block times under 100 milliseconds, and fees less than a tenth of a cent, making Aptos more than 100 times cheaper than other leading blockchains. Built by the team behind the DM project at Meta, Aptos is what blockchain performance looks like when it's built for global financial markets. Discover why global institutions like BlackRock, Franklin Templeton, and NBC Universal are building on Aptos, and see for yourself at the Aptos Experience, October 15th to 16th in Brooklyn.
So, YQ, just to follow up on what you said, and I want to get Carlos's take on this too. What can be done to improve liquidity? I mean, obviously, as the industry grows, there should be more market makers, more traders, everything. But especially for some of these long tail assets that I think it's fair to say will face these issues time and time again. Are there ways to better manufacture liquidity, or is it more an issue from exchange execution that, especially on the CEX side, that they do a better job of stepping in, maybe having bigger insurance funds, or is it a matter of having more transparent ADL policies? I'm not sure. What do you guys think?
So a few things I can sort of share because I'm also writing some other like sort of articles on further investigation into some details of this liquidation event. So one thing I think for CX or DX, they should really carefully select sort of the assets into their spot and the perp sections. Because for some of these assets, right, if they don't have enough liquidity themselves, they are super easy to be manipulated. No matter is sort of the spot price or this kind of the perp or the market price. The issue is not about just pure about liquidity. That since this is a small asset, right, chosen by the CEX, there are always a lot of these kind of whales. They want to make more, so they want to manipulate the price. And in that case, like if you sort of because a lot of users don't understand what kind of token it is. They just know there's a ticker, it's pumped, and then they will just follow. So that sometimes really hurt. And beyond that, as Steven, you mentioned, right, the ADL is not perfect everywhere, because like once ADL is triggered, that means it's already in the extreme situation, and basically hedging is no longer working. Like either the ADL is for the long side or for the short side, right? The other side is not working. It's basically immediately you don't have the hedging like sort of opportunities anymore, unless you really have a super powerful like 24/7 team, like sort of can really pull the bees immediately. So of course we need more transparency for the ADL. For most of CEX, the ADL mechanism is not transparent. We don't know like sort of what kind of mechanism they are doing. For example, for a lot of my trader friends, they don't know when their short position got closed. And then how about their long position? Can the long position got like sort of closed simultaneously? That was not real. It's basically all their long position got liquidated instead of like ADL. So there's so many like sort of uncertainties here and there. I just feel like there's multiple ways we can fix it. One is like probably like GSL or the other market makers, they should really figure out ways to provide enough liquidity during the crash. It will be a huge risk because you don't know whether market will recover, and you don't know like when is the best timing for you to pull beats. The second thing is like we literally need to fix this Oracle issue for CEX and DX. For example, the USDe, Guy mentioned like it's perfect fine off chain. You can redeem whatever like $20 billion if you want. But the issue is like on chain side, the CEX side, they have most of the volume. They have to rely on the spot price because like people are trading. They don't have the direct way to redeem on chain. So that's another like Oracle issue. We need to figure out the best way. Of course, the ADL, as you mentioned, right? There's no perfect ADL. Every exchange has its own ADL. Some exchanges I learned, perp they don't even have ADL. So you should literally be like sort of responsible for your own like sort of positions. These are all the new things because perp is still very new. So I believe Ram probably can give more like sort of sharings based on the Web2 experience.
I don't know if you can share that. Do you see that, Steven? So this is a post from a friend of the show, Chris Perkins. Chris is a partner at CoinFund, and he's a part of the subcommittee that advises the CFTC on digital assets. The CFTC regulates U.S. derivatives and the U.S. clearing houses, including clearing houses like ICE, which is, I believe, the largest derivatives clearinghouse globally. So TradFi has solved this problem. That's the headline statement. And the way it works is every clearinghouse is regulated to have 5 layers of protection. And Chris lays them out here. So the first layer of protection is called variation margin. So that's when if the price is moving against you, you've got a post margin to get back to acceptable levels of leverage as governed by the system. If you don't post margin, then you get a margin call, right? Another margin call. The second level is you seize the initial margin of the person that's borrowing. If they default and they fail to post margin, you seize that initial margin. Ideally, that plugs the hole. But if prices are moving too much, then the clearinghouse has its own equity layer cushion, so it can contribute to this as well. After that, what happens is there's a default fund. It's not an insurance fund, it's a default fund. And members of the clearinghouse contribute to this fund in the same way that banks contribute to the FDIC insurance fund. Those contributions are made via different mechanisms, including like an assessment. So an assessment is you pass the hat around, you say, everybody pony up, we got to fix this hole. And then the last step is recovery and resolution, right? That's another way of saying like a bankruptcy-like process where you have an auction of assets. So after the demise of long-term capital management, which people thought was the big hedge fund back in the day, the late 90s or so, books written about this, one of them on my shelf here. What they did is they they looked at like resolution processes for these assets, have an auction for the process. So TradFi solved all this. Now, Chris goes on to say, yes, in other words, socialism, which is kind of a funny response here.
I
But
guess
that's actually regulation. That's actually, I would call that like good regulation. That's good regulation. Now, to make that come together, you need a some framework to govern these exchanges. Obviously, Binance is international; it's outside the scope of U.S. regulation.
So we've spoken, I think, about two of the three big causes so far at some length. I mean, one, lack of liquidity or issues with liquidity. We've discussed some of the break the glass scenarios that exchanges have to go through and problems there. I want to just briefly touch on leverage too, because like all of this was that was sort of the stack of dry leaves or sticks that was able to be set ablaze. And there's some interesting narratives going on. I mean, for one, what was it like how much? Yeah, like $65 billion in open interest was news, which is a huge number. But this long bull market has kind of like led to just a slow growth in leverage. But I'm also hearing too about how some people were liquidated even if they were only like 1.5x leveraged or 2x leverage, which may not. It's a big difference from being 30 or 50 or 100x. So I'm curious, like what you guys think. Maybe Carlos, you can jump in here first. How should people think about leverage in crypto? What are some like how unhealthy do you think leverage was before all of this happened? And like, are there warning signs? Are there things that people can do so that, or is it just history going to repeat itself where leverage just creeps up and up and up during bullish periods until there's sort of it's almost like burning acres in a forest to allow for regrowth. What do you think?
Yeah, I think actually my response kind of like ties into like what Ram was saying. I mean, I think part of the problem goes back to cryptos. There's lots of speculators in crypto and degens, and that can be largely fine. But I think that creates a situation where exchanges are incentivized to offer greater and greater leverage to attract speculators and provide like good, like the experience that they're seeking, which is high volatility, potential to make a lot of money very quickly. But I think we've gone into a situation where exchanges offer a lot of leverage, and there's potentially a lot of traders taking on a lot of risk that oftentimes doesn't really come back and bite them in a big way until there's potentially a big like black swan event. Or what happens is a lot of traders are taking leverage in ways that individually might seem rational, but then when there's a big market crash, you get like a systemic risk where everything gets correlated because one person gets liquidated, but then that means like the price goes down and like someone else gets liquidated, and that ends up liquidating everyone, down to the people who didn't even take that much leverage, and like they thought like they were in a safer position, or they thought they were like delta hedged, but even then like their long position gets liquidated. So I think it's kind of a coordination problem. I mean, either there's going to be a behavior change where people might not take that much risk. I don't really count too much on that happening in crypto. Or we find ways to coordinate across exchanges, to find ways of either self-regulating or finding some of these other mechanisms that can improve liquidity. One other thing I was going to mention that could be a mechanism that crypto can explore is circuit breakers. These can provide a pause in trading while everyone just
How does
sorts
that
out.
happen on a permissionless 24/7 market, though? I like all your other ideas, by the way. They're all great, but this one,
I know circuit breakers have been talked about for years. I mean, they're centralized exchanges. I can certainly understand it, but I mean, Carlos, I'm sure you know this as well as anyone. They're almost anathema in DEXs. But I'm curious.
First, you can't trade on your exchange, but then the spot price representing your collateral value keeps going against you, and now you're saying I have more risk, right? Or you have a position on exchange A and a position on exchange B, and they're hedging each other. You're doing some cross-market arbitrage. Now you're frozen here. Could actually be creating risk. So I like the general concept, what you're saying, especially the self-regulation. That won't happen, unfortunately, but it's really what's needed. The NASD, which preceded NASDAQ, was a self-regulatory organization that was born in the wake of all the scandals and nonsense that you saw in the pink sheets market in 1950s, like a lack of standardized disclosure, conflicts of interest. So the industry came together. They formed the NASD, which subsequently evolved to FINRA. And FINRA, the board is composed of members of the buy side. I believe it's led by the former president of Bridgewater. That makes sense because the market ultimately is about serving investors. It's about investors. If investors are happy, then that means other things are working downstream. Focus on making sure investors are happy. They'll drive accountability in the right areas. There has been no self-regulatory organization. There's no incentive for anyone to build one. They need to do that, though, because if this were to happen in the U.S. or in a regulated jurisdiction under a different administration, and if retail investors lost a lot of money, then you'd have the heavy hand of government come down and force regulation.
Yeah. Well, speaking of building on that, Ram, I mean, it's kind of interesting that this happened and we're having this conversation. And I'm not ignoring the irony here that we're talking. I'm in Philadelphia, Ram. I guess you're in North Jersey. Carlos, you're in Spain, and YQ, you're in Singapore. But we're having this conversation while the government is closed, and anyone who sends a message to the SEC gets a very nice reply saying we are not monitoring our email accounts right now until due to appropriations. But
it's a circuit breaker.
Yeah, exactly.
Well, look, if you did email them, they still wouldn't respond, Stephen. Come on. 9 months to see what you got me.
Fair enough. But
9 months would go by, and they would say, we acknowledge your request. Can you get in line? And we don't know what your request said, but here's a form response. Good luck. And go to the SEC.gov website and fill out another form. That's what happened.
But anyway, point taken, Rob. But anyway, we're in the middle right now of what appears to be intense negotiations, notwithstanding maybe actually a DeFi hiccup on the part of Democrats, which perhaps maybe is much more relevant now than even was a couple of days ago. But we're trying to negotiate market structure legislation together, and this is a perfect example of why it's so critical, and that the discussions about it have a lot more to do with what kind of token is a security, what is a non-security. I mean, handoffs between the SEC and CFTC, these types of resolutions when there's periods of acute stress. Like as Ram, you were saying, this was solved for the most part in TradFi. This was, I guess you can make an argument, the worst day in crypto's history. So it's not the norm, but a lot of people lost. I mean, I know that the $19 billion liquidation number doesn't actually mean $19 billion was lost, but this impresses the importance of getting regulation, and I think also underscores how difficult it could be to get it done by the end of the year, which is what people want. I haven't read Clarity or closely enough in recent days to understand exactly how this part fits into it, but I'm sure that everyone is talking about this and how it fits into the discussion.
So they just some extra stuff on the crypto compared to TradFi, because like Steven just mentioned about like sort of what are the measures we can apply, right? The thing is, crypto, especially for perpetual, right? There's no clear definition in the US. I mean, even Coinbase has a perpetual, but it's like 5 or 10 years futures, right? It's something completely new. And then for this time, I think one of the root causes is really about this we call cross margin or unified account. So basically, all your assets are treated as a collateral when you open long or short positions. And that means like even you open like sort of 1x long during this kind of market crash, right? It's basically everything, all your position, all your like sort of assets in your unified account gone. Even 1x. So because like it dropped like 99%. It's super crazy. And beyond that, we also have something called this. I'm not sure whether you guys are doing some DeFi protocols. We have something called looping to get extra yield. For example, we deposit USDC, get the USDe, and then we can learn like USDe, get USDC, and then we deposit USDC, get more USDe, and we do this kind of looping to get this extra APY. It's not like this kind of perpetual, it's a lending, but as you can see, right, we can get as much as high as like sort of 3 or 5x leverage. Because a lot of users treat it like it won't depeg, or it's always one-to-one mapping. But in reality, like for example, in this kind of market crash, right, it is no longer working. There's a lot of hidden leverages here and there, especially in crypto. There's a lot of new stuff. I think it's good, like we can have some regulation, but at the same time, I think right now immediately we need to figure out ways to really alert users, like for all different risks they are like sort of facing.
No one's reading the EULA, the end user license agreement. Disclosure is not the answer to this complex question. When you have a user that's looking for 100x leverage as the primary value proposition on the perp, they're not like, let me look at page 9 of the disclosure, right? But what do you think about Hyperliquid? Is Hyperliquid a winner or a loser coming out of this?
At the beginning, I feel like I can't say it's a winner or loser, but like out of this 19 billion I saw liquidation, like 10 billion from Hyperliquid. That's why from their they call HLP. It's basically their vault earned like $40 million immediately. So of course, people saying that it's good for Hyperliquid, but when you think about for the users, right? A lot of my friends got liquidated due to the ADL mechanism. At the same time, ADL like sort of like sort of earn or loss for them, but at the same time, on the other side, they're also doing hedging. The other side, basically everything got liquidated.
Right. So
I think for users, definitely it's not good. But of course, Hyperliquid showed that it's pretty stable during this event.
I think they're a winner. I mean, Hyperliquid, yeah, what you're saying is like they made money. Unfortunately, they made money through this high volume of transaction activity. Customers,
their own users.
Their users. Yeah. That's now. But on the users, again, it's a derivative. So there were winners and losers on that side. These are derivative products. So derivative, that's a zero-sum transaction. The unfortunate part is that their users were carried out and liquidated at the exact worst time, and it wasn't in their control. That's what makes this terrifying. But there were, you could call it like responsible players that made good decisions, but due to market structure issues, they were liquidated. That's really the worst part about this story. So, but I do think that, I still think they come out ahead as a winner here, though. I think that's my view. But I agree. Like on your point, like anyone that was subject to this ADL issue is any user is a loser, of course, right? But some exchanges, like Binance, took some reputation risk. They had to, like they gave out the statement. They said, "Hey, we apologize. We made this change." They said we have many lessons to learn. I don't think they had an apology. That might be an admission of liability. We're reflecting. We have many lessons to learn, and they've since updated kind of the whole Oracle mechanic works.
Well, I think them paying $283 million is a certain admission of of something. But I know what you mean, Ram, in like the legal sense, and who knows? I'm willing to bet there are plenty of other people that aren't included in that 283 million that might be looking at other forms of recourse. And I'm curious, like the phrasing, the winners and losers, because I mean, Hyperliquid certainly passed, I would say, a stress test. I mean, DeFi overall, I think, did a pretty good job passing the stress test. But if we're defining winners as somebody whose reputation was burnished
DeFi did fantastic.
yeah, it's hard. So, Carlos, let's look ahead and let's talk about what the market's doing today. I know we sometimes can joke about Taco Trump. He sent out a tweet on Sunday telling everybody to calm down, that his 100% tariff threat was, I'm not sure it was a joke, but that basically will figure a way out of it. And the market seems to be taking him at its word. TradFi's up. Bitcoin, as we're recording this, is at about 115,000 and change. ETH is back up above 4,200. BNB is above 1,200. And the market seems to, it hasn't obviously gotten back all of what was lost on Friday, but it's certainly recovering. What are you seeing right now, and kind of like what are some of your expectations in the ensuing days, assuming that there's not another big shock?
I mean, I fully expect we'll see more of a return to normality. I mean, notwithstanding any, further just chaos on like the tariff side and like that, happening again. But it seems like, over the weekend, the Chinese government kind of clarified that, their announcement or like their restrictions on like rare earth metals exports, like were like kind of like potentially miscommunicated or misunderstood by the U.S. government. So we saw like the Trump administration kind of over the weekend also walking back the threats of 100% like tariff restrictions, which I think like really, really calmed markets. So, I mean, I think we're with that passed, which is, it's a little bit ironic because tariffs don't really have a direct impact on crypto. If anything, crypto is an asset class that could be seen as a hedge against assets that are directly impacted by rising prices of imports, like, a lot of equities and other assets there. But notwithstanding, I mean, we know crypto is highly correlated with equities, and I think like the response was basically just a similar reaction to what happened in April, and everyone just being very much primed to react negatively to tariff news. But I think it seems like things are largely back to normal on the trade side. I mean, there's still some uncertainty on exactly how the agreements within the U.S. and China will play out. I think largely we have a lot of tailwinds in crypto, and notwithstanding like those relationships, once again, flaying, I think we can expect the market to kind of keep recovering and get back to pretty much where it was.
Okay. I mean, Ram or YK, do you guys have any thoughts? I mean, one chart that I had been paying attention to was sort of like plotting like major stock indices with crypto, where like stock indices kept going up and setting new highs. Yeah, I mean, it was even on set to do it again on Friday, and the crypto market cap had kind of been staying flat for a few weeks or so, and that kind of fed into, I guess, one of the concerns that I might have had that. I mean, crypto has been propelled by the Trump administration, a lot of positive stuff coming out of DC. The DAT narrative, even though the DAT narrative, and we've explored this, Ram, isn't everything it's cracked up to be, because a lot of these big raises that we found don't necessarily represent net new buying, and perhaps it was a little bit of a facade. So perhaps like the market was sending us signals of weakness or skittishness in the event of a bearish stimuli, which we saw in spades. And granted, it was accelerated because of the acute issues at Binance and stuff that we discussed. But I wonder if this is going to be a warning sign for some additional retrenchment and hedging, even if the market sort of like goes back on a similar path, because people don't necessarily want to get burned again. Like I wonder if that's one of the bigger takeaways from what happened. Ram, you disagree? Go ahead.
Can I make my nothing burger comment?
Yeah, go ahead, Mr. Nothing.
Okay, so let me share my screen here. First, I'll share the Bitcoin real quick, and then we'll shift gears. Well, actually, so this is an interesting one. This is when I was at the Puerto Rican airport waiting for my flight home. As I'm landing in Newark, by the way, that evening, my phone is blowing up with Bitcoin down 5%. And I'm like, well, I'm just seeing all this price. These are just notifications when broad price moves happen. Pretty wild. But I was at the airport in San Juan, and they had tacos. And so I saw this place card, and I wrote, Trump's next move is on this note. If you zoom in, it says taco style. So I think this is a great buying opportunity where we are tactically. Let me share another screen here. This screen is the price of Bitcoin. And what's happening is you have these Bitcoin whales that are consistently selling at around 125K, right where this level is here. Okay. That explains, Stephen, the point you raised earlier, which is it seems like total market cap isn't rising while other asset classes are rising. So these whales are distributing at these levels. The question is how much supply is there and are they done selling? Now, the flip side is this. Those people that are selling, guess what? They have a lot of cash, right? These are buyers. And what do they do here? This liquidation wick, they're buying. Every buyer is a seller. So there's ample liquidity. And we bought into this liquidation. Liquidations are generally bullish, by the way. They're generally bullish. This is a massive, massive liquidation. And I think the lows are in. Very simple terms. Are the lows in or not? Yes or no? Yes, they are. How far ago in the rearview mirror is it? Yesterday. Okay. So risk reward looks pretty good. The risk is just beneath where I am. Reward is higher than that. But I think it's a tactic. What that means is you have to reassess, some period of time later. It could be a week or a month or 3 months, and then revisit, because you do have this selling pressure at 125K, probably from Bitcoin whales that are looking at the 4-year cycle, etc.
Okay, so let's start to wrap up, and kind of in that vein, Ram. I mean, I want to ask each one of you, like, what are one or two things that you're looking for in the days, weeks, months ahead, either good or bad, and it could relate to the market. I know there's a lot of discussion and speculation about who got blown up potentially, and sometimes it's not necessarily the first blow, but it could be the second. So Ram, let's just stay with you. You can finish your thought.
Sure. Yeah. Look, I'm optimistic and bullish now. I think last week I closed off by saying sometimes do nothing. Like where we entered last week, markets were overbought. There's indigestion needed. Things were priced for perfection in many, many areas. You had this clearing event on Friday that reset sentiment, reset positioning. People had the memory and trauma of tariffs and said, oh, it's back again. They hit market sell. They hit the bid. VIX jumped up 30%, which is real palpable fear. That's real fear. These are conditions that are similar to August 5th of last year at the culmination of Yen-Mageddon, although different. It's always different. It was one day instead of a multi-week event that kind of built up. So I'm bullish here tomorrow. The big banks report, like JP Morgan, the Bank of America. Prediction, they're going to beat their numbers again. Prediction, consumer credit will be healthy and fine. Consumer spending will be going up year over year. You'll see record mortgage refinancings coming out of Wells Fargo. The consumer is fine. And there's a lot of credit fear in the economy right now. If you look at like BDCs and private credit, private equity firms, CLO issuers, I think you're going to start to see those start to stabilize and rally. So yeah, I'm feeling pretty optimistic here. Earnings growth expectations for the quarter ahead are like 6%. We just came off a quarter of 12% year-over-year earnings growth. That's not going to stair step down to 6%. So people still have this PTSD. One other quick anecdote for you. I had a conversation with two friends in Switzerland this weekend. They're center left, and they volunteered to me. They said, well, I own one stock and everything else is in cash. And there's a study that shows that if you ask people their political preference, it tells you their sentiment about markets and the economy and are we in a recession or not, this stuff. It's the correlation is very strong. So like they have Trump derangement syndrome. That's what they have. They're friends. I love them. They're wonderful people. It's not a critique of their person. but you have to step outside your political views when you're making an investment decision. The point there is a lot of those people have cash. They're going to have to chase this market higher. So that's another reason I'm bullish going into Q4.
Got it. Carlos, let's go to you. What are you looking for?
I think high level on the market, I would echo Ram. I think I'm very positive. I think unlike I kind of think the 4-year cycles are sort of over. We haven't had a 4-year cycle going into a rate cutting cycle. I think this time is kind of really different, and crypto has a lot of tailwinds across regulatory adoption, things that haven't been true in the past. But I think the two things that I'm really looking towards in the next few months, just related to the Friday's specific events. I think one is whether there's any actual change in trader behavior. I think a lot of people got burned really badly on Friday. I think most of these have been crypto native traders in Wales. I actually don't think it was a large number of the new retail that had been onboarded into crypto. I think most of those traders, for the most part, trade spot. I think most of the people trading perps are a little bit more crypto native, more deep into the industry. I guess I'm very curious whether we go right back into leverage building up in perps and people kind of behaving the same way, or if this drives any change, moves people towards either less leverage or different derivatives like options and different behavior there potentially. And the other thing I'm kind of looking forward to is just how exchanges react. I'm curious whether we'll see more coordination, potentially greater use of insurance funds, whether we'll see more insurance funds in DeFi. I think something that was kind of missing on some of these centralized perps exchanges, while they have some of these vaults that act as market makers and oftentimes step into do liquidations, they're not really insurance funds. And oftentimes, because of their risk limit, they won't take the liquidations after a certain point, and that's when ADL will kick in. I guess I'm curious to see whether we'll see the rise of insurance funds in a bigger way.
Okay. And YQ?
I still feel like it's a big hit on all the small retails, traders, even some liquid funds, especially for altcoins and builders. It will take a long time to recover because, as you can see, right, this heavy sort of 80 or 90% down for most of the altcoins. So, but they are more like the small businesses in crypto. So they are basically the blood to really support the entire emperor for, for example, the major coins to really get main adoption. But for this time, I just feel like a lot of these projects, builders and traders got hit a lot, and it takes a long time to recover. And beyond that, I feel like in the current crypto, it's a quite sort of on two sides. One side, on the small altcoins, for them surviving is already super tough because it's very difficult to get liquidity, difficult to get users, and difficult to get VC money. On the other side, it's this crypto Max 7, Bitcoin, ETH, and Solana XRP. They constantly got this Wall Street money for DAT and all the things. So that's why if we look at the overall market cap, right, it doesn't change much because Bitcoin and ETH, their sort of ratio much higher, but the small ones become lower and lower. So I just feel like after this, it takes a long time for these kind of small businesses to recover for the next few months or next 1 or 2 years. But for the big tickers or the major coins, I think they will eat well from the Wall Street and also the big institutions.
Yeah, I agree with what all you guys said. I'll just add two quick things on my end before we wrap up. One, I forget who said it. It was either UYQ or Carlos. I'm curious how exchanges might reconsider listing procedures because, especially for some of these altcoins, I mean, they already have stated procedures. They want to make sure that smart contracts are technically sound, that the tokens themselves or blockchains aren't being used for fraud, that there is sufficient liquidity. But given what happened on Friday, I think it makes sense for some of them to reevaluate what that means. And two, we didn't get a chance to get into this too much, but I think Laura is actually interviewing Guy tomorrow on chain, so she'll get into it. But it's really ironic that the DeFi, or I guess the perp dexes were saved because they hard coded the price of USDe. And I mean, obviously, there's plenty of room for criticism on how Binance did it, but just the idea that a DEX was the one that centralized what the price was going to be and it saved them untold amounts of money. That's irony, and I'm curious to see what that looks like.
Amazing. That's a hack in a different situation, though.
Yeah. So
that's a hack in the world where it actually does break the buck, and then you stuff them with as much.
Yeah, exactly. Exactly. So with that, Ram, as always, YQ and Carlos, thank you for joining us for this really interesting and timely discussion. Thanks to everybody for watching and listening, and we will be back next week with another episode of Bits and Bips.